What is insurance and why do we need it? Why is the system starting to break down? What is happening with home insurance? A simple explanation. In the past, risks were predictable. Storms, fires, and accidents happened rarely and in limited areas. Insurance is a way to share risk. Many people pay a small amount to help those who experience a loss. Insurance companies collected premiums and paid out claims. The system worked stably. But most importantly, insurance isn't just protection, it's economic permission to operate. If something cannot be insured, banks won't lend money, investors won't fund it, and regulators won't allow it to operate. Why is the system starting to break down? Risks have become more frequent, larger in scale, and less predictable. In 2023, the U.S. experienced 28 climate-related disasters, each causing over $1 billion in damage. Previously, the average was fewer than 9 per year. Climate change, geopolitical conflicts, inflation, and aging populations are compounding each other. Insurers find it harder to forecast losses. They're losing confidence in their models. What's happening with home insurance? In the U.S., about 6 million homeowners are now uninsured, representing $1.6 trillion in unprotected property value. Insurance costs have risen by 10 to 12% in a single year. In Canada, rebuilding costs after disasters have increased by more than 50% since the pandemic. Reinsurance, insurance for insurers, has also become more expensive due to frequent large payouts. In California and Florida, major insurers have paused issuing new policies or exited the market entirely. How does insurance affect the economy? Without insurance, banks won't issue mortgages, demand for housing falls, prices decline. Farmers cannot get loans to plant crops. Without crop insurance, production becomes riskier. Shipping companies reroute vessels if insurance for certain zones becomes too expensive, e.g., the Red Sea. Insurance companies manage enormous capital pools, over $1.4 trillion in the U.S., investing in government bonds, infrastructure, and housing. In this way, insurance finances a significant portion of everyday economic activity. How does the math of insurance work? Like a casino, it doesn't matter if one person wins. What matters is that the rules ensure profit on average. An insurer doesn't need to know if a specific house will burn down. What matters is that losses are predictable across millions of policies. Premiums are collected up front, while claims are paid later. This creates large reserves that can be invested. Investment income is often more important than the difference between premiums collected and claims paid. Why have risks become unpredictable? Climate-related disasters have more than doubled over recent decades. Human-amplified natural disasters, floods, droughts intensified by human activity, have nearly tripled. Wildfire season in California now starts more than 10 weeks earlier than it did in the 1990s. In Europe, 2024 was one of the wettest years since the 1950s. Rivers overflowed more frequently. Insurance models based on historical data are becoming less reliable. Pressure on reinsurers. Insurance companies transfer their largest, rarest risks to reinsurers, Munich Re, Swiss Re, and others. Over the past decade, global insured losses from natural catastrophes have regularly exceeded $100 billion per year. Reinsurers have responded by raising prices, tightening terms, and withdrawing from the riskiest regions. This forces primary insurers to either raise premiums, reduce coverage, or exit markets entirely. Challenges in health insurance. Healthcare spending in the U.S. now exceeds $5 trillion per year, minus 18% of GDP. New medications, e.g. for diabetes and obesity, cost tens of thousands of dollars per patient annually. Gene therapies and cancer treatments can carry one-time price tags exceeding $2 million. Populations are aging, more claims, higher premiums. Between 2000 and 2023, the average cost of family health insurance in the U.S. more than quadrupled, while overall inflation rose by roughly 80%. Healthier individuals drop expensive coverage, the risk pool becomes smaller, and sicker prices rise further. What happens when insurance disappears? Large companies can afford expensive policies or self-insure. Small businesses and ordinary people cannot. Employees lose employer-sponsored coverage and move to more expensive individual plans. Homeowners in high-risk areas are left unprotected, even if their homes have not been damaged. In 2022, in more than 150 U.S. zip codes, at least 1 in 10 homeowners lost insurance coverage due to non-payment of premiums. The role of government. When private insurers withdraw, governments often step in. In the U.S., Tax breaks for employer-sponsored health insurance cost the federal budget approximately $384 billion in 2024. In Italy, starting in 2025, all businesses must purchase insurance against natural hazards, and insurers are required to offer such policies. Governments also provide reinsurance support to reduce pressure on the private sector. However, this can create moral hazard. People may build in dangerous areas, expecting government support if disaster strikes. Alternative solutions. Parametric insurance. Payouts occur automatically when a predefined trigger is met, e.g., wind speed, 150 kilometers per hour, without damage assessment. Fast, transparent, but requires sophisticated modeling. Risk reduction incentives. Discounts for installing fire suppression systems, reinforcing buildings, or creating protective infrastructure. Public-private partnerships. Governments assume part of catastrophic risk to keep coverage accessible. Key takeaway. A world where insurance stops functioning effectively becomes more unequal. Risks fall on those least able to bear them. More fragile. The economy loses its capacity to take calculated risks. Less innovative. Without insurance, launching new projects, building, and investing becomes harder. Insurance is not just a piece of paper for emergencies. It is a foundation supporting trust, lending, and economic growth. If risks continue to rise while models lag behind, the system will be forced to adapt. How we manage that transition will determine the resilience of the entire economy in the future. I hope it was clear to you. Bye.